This is all stuff that I cover in Does It Pencil. It's informally what was known as Course 3, and it will be in the new course just called the Tax Course. But I wanted to take a minute before he got here just to kind of refresh and review you on a couple things, okay? So first of all, capital gains, the tax, especially, now I'm talking here primarily about real estate because y'all are real estate people. And what I want to do first is just go over some real super basic stuff, okay, that a lot of people don't know but should know. When you're looking at a capital gains analysis on the sale of a piece of real estate, there's actually two taxes that are due. A lot of people don't think about this. There's the gain, which is one kind of tax, and there's the depreciation recapture. Okay, so the way that I'm going to talk about this is starting with those two boxes, the gain and the depreciation recapture when you go to sell. Okay, now I'm not talking about doing a 1031 tax deferred exchange. I'm not talking about an installment sale. I'm talking about an outright sale for cash. And I'm talking about selling a piece of property that has been held by the taxpayer as an investment property. I'm not talking about your primary residence. I'm not talking about your vacation home. Okay. Now, a vacation rental is different. Okay. If the owner has accepted income and taken depreciation, then this conversation applies. But it's just like, oh, I've got a beach house and we go there 3 weeks a year and other weeks of the year it's dark. This doesn't apply. Okay. This does not apply to your primary residence as you declare as a taxpayer, what the tax code would call your tax home. Okay. This is different. This is a property held for investment. All right, let's start first with depreciation. And I'm not going to give you a big, long lecture about this. I want to keep this kind of short because I was waiting for our guest speaker. So I can do more detail on this at a later date if you want, but here's just kind of the capstone summary. You take this as you go. So you take it every year, and the beauty of it is that it's treated as an expense against income. Okay, now you don't write a check for it, you just do it on your tax return. But the way that it's treated is that is an expense against income. So what that does, as I'm going along my merry way as an owner, is that reduces the amount of income subject to tax every year. Therefore, it reduces my tax liability. Therefore, it allows me to keep more of my own money to grow for my future wealth. So in a way, it's kind of like a Roth IRA compared to a traditional. Okay, you get to keep more of your own money. But the problem with all this tax stuff, and I'll talk about this here in just a minute, is that you're always dragging around the future consequences with you. They don't go away completely. And that's one of the cool things about what Carl does, is that he sets up entities and structures so that you never recognize what you're dragging around with you. But notwithstanding that, just kind of note to self, you're always dragging this around. You're always dragging around your depreciation. But as you go about your merry way as an owner, you're paying less tax because you can take this depreciation and impute it as an expense against income as you go. Okay? And I'll talk about how the tax is treated on that here in a minute. Okay, the second kind of the tax is the gain. All right, now there's a couple things to remember about capital gains. First of all, you have to look at the length of ownership, okay? And the trigger here is 1 year and 1 day. Okay, now when I was doing my graduate tax work stuff with the IRS, they were very emphatic about the fact that it's not 1 year, it's 1 year plus 1 day. Okay, so if you own an asset more than 1 year and 1 day, it's treated as what I'm going to call an LTCG, just easier to read because, my handwriting and stuff. Long-term capital gain. Okay, 1 year and 1 day, long-term capital gain. The inverse is less than 1 year. Okay, and that's a short-term capital gain. All right. So there's two kinds of gains. Morning, Carl.
Good morning.
I'm glad you're here. I got about 5 minutes and then we'll onboard you, okay? I'm just finishing up some stuff. All right, so we got these two kinds of gains, the short-term and the long-term. Short-term capital gains are taxed at your ordinary income tax rate. So it's just like income, but you don't pay FICA tax on it. I'm just talking about federal income tax and state income tax if the asset is subject to that. All right. If you have a long-term capital gain, your tax treatment is different. It's typically 0, 15, or 20%. Okay. So this can seem a little bit weird. I don't want to get in the weeds here. I want to hand the baton to Carl. But essentially what happens is if you think about income like a ladder, like the more you make, the higher it goes, what happens is your capital gains income is stacked on top. Okay, so simple example. I make $200,000 in taxable income in a year, and I sell some stocks and I make 50 grand. Okay, the 50 goes on top of the 200. That's how IRS treats it. And because federal income tax systems are progressive, the more income you make, the higher rate each subsequent dollar is taxed at. Okay, but what happens, this 0, 15, or 20 business, is that these are tiers. Okay, so if you're in the 15% bracket, your gain is only going to be taxed at 15%, the gain portion of income that year. If you kick up into the 20% bracket, your gain will only ever be taxed at 20%, meaning it won't go up to the highest rate of 37% currently. So capital gains rates are cutoff rates, and that's different for long-term than short-term because short-term, there is no cutoff. Okay. Now, when we do Does It Pencil worksheets and discussions and talks and stuff like that, I tell people, if you're going to estimate this, estimate it at 15%. And here's why. Because currently in the code, if you are single, you don't kick into that 20% bracket until you make over about, $533,000. So if you're under this, you're still going to pay at 15%. If you're MFJ, standing for married filing jointly, you don't kick into the 20% thing until you make about 600,000. So anything less than this, you're at 15%. Over, you're at 20. Okay. So for discussion purposes, for most folks, I say, look, if you're thinking about selling and you're thinking about what's my tax going to be, just figure about 15% on the gain portion. Now, remember, if we go back to the beginning, I said there's two buckets. There's the gain and the depreciation recapture. And the depreciation is recaptured at a federal rate of 25%. Okay, it's progressive up to 25. But again, in Does It Pencil, I tell people just estimate it at 25%. Okay, now we go over that in a hell of a lot more detail and so forth in Does It Pencil. But I just kind of wanted to give you a taste of this. And the last thing that I want to say, and I'm going to turn it over to Carl here, is this. For me as an instructor, for me as a taxpayer, for me as an investor, for me as just someone who's been doing this for 40 years of my life, there are two words that if you don't really understand this stuff, that I think are the most important words that you must remember. And the words are adjusted basis. This is where all of it is triggered. Sorry, Kelly, I spelled that wrong. Let me try to erase it. Anyway, it's BASIS. You understand. Sorry. Okay, so what is your adjusted basis? Well, this is what it is. It's your price plus your capital improvements minus the depreciation you've taken. Okay, this is your adjusted basis. Your sale price minus your adjusted basis is your gain. And again, baked inside of this, you have what I call the pure gain and the depreciation recapture. All right. The good news is all of this will be on the video so you can look at for your viewing pleasure at a later date.